Here are the top 4 ways that the central bank influence currencies. Well, first of all, if you trade Forex and you don't understand how the central banks work, I'm sorry to tell, but you're trading blind. So grab your notebook and let's go for the first one. So the first one is the interest rates decision. Basically, higher rates will attract capital and lower rates will push it away. So when a central bank hikes rates, it boosts the yield-seeking flows into that currency. So when they lower the rates, it makes that currency less attractive. So when the Federal Reserve rates, US dollar usually strengthens. The second one is the forward guidance. It's not just what they do, all right? If a central bank signals more hikes or cuts ahead, the traders will price that in before that even happens. So that's why we mean by dovish and also hawkish. And the third one is the direct effects interventions. Okay, so sometimes they skip the talk and they actually act directly, as I like to say. So some banks, they actually buy or sell their own currency to control the volatility on the competitiveness. That's very rare, but it's very powerful. So let's say that the Bank of Japan, they are the ones that usually do that the most, because BOJ, the Bank of Japan, is usually with lower yield, so the currency is very weak. So what they do is they try to buy the currency to stimulate more money to go into that currency. So a quick example of that is the US dollar, Japanese yen. So, and the fourth and last is the quantitative easing and quantitative tightening. Okay, so quantitative easing is basically they are taking money out, money into the economy. So they're printing money and putting money into the economy. And quantitative tightening is basically they are taking that money out from the economy. Look at how they do that, because there won't be Jerome Powell going knock knock knock, give me your money, knock knock knock, give me your money, or here's some money, here's some cash. No, basically quantitative easing, they print more money and make money more accessible in a sense for population. So higher rates, higher average hourly rates and that kind of thing will give more money for the population. And having the banks having this is a little bit off topic, but having the banks with holding more cash for the rates, that's usually also. And the quantitative tightening is they stop printing money, they put the rates higher and make harder for you to get access to the money. Now you know the top 4 ways that the central banks, I would say, not manipulate, but actually work with conjunction on the FX market.